Friends, thank you for being here today. What if I told you that the United States government now spends more money servicing its credit card than protecting its borders? Not slightly more, significantly more. We're talking about a crossover that happened quietly, without fanfare, without emergency press conferences, without the alarm bells that should have been ringing from every corner of Washington. The Treasury's own data confirms it. Interest payments on the national debt have eclipsed the entire defense budget of the world's most powerful military. This isn't a projection. This isn't a worst case scenario. This is the mathematical reality of where we are right now, today, at the end of 2025. Let me be precise about what we're looking at. The United States Treasury paid out over $970 billion in interest on the national debt in the most recent fiscal year. The Department of Defense, including all overseas operations, all the aircraft carriers, all the bases scattered across the globe, all the personnel, all the weapon systems that supposedly keep the empire afloat, that budget stands at roughly $882 billion. For the first time in modern history, the cost of past mistakes exceeds the cost of future security. The cost of yesterday's borrowing now dwarfs the cost of tomorrow's defense. This is the exact moment when a superpower crosses the line from dominance to managed decline. And this part has already begun. Here's what that looks like in household terms, because the numbers we're dealing with are so staggering they lose meaning. Imagine you earn $5,000 a month. You spend $2,000 on your mortgage or rent, reasonable, but then your credit card minimum payment, not paying it off, just the minimum to keep the account open, hits $2,500. You now have $500 left for everything else: food, utilities, transportation, clothing, emergencies. That is the United States balance sheet right now. That is the architecture of the federal government's cash flow. The empire's mortgage has come due, and the numbers simply don't work anymore. This is vanishing in real time. Now, most people hear interest payments and their eyes glaze over. It sounds bureaucratic. It sounds like an accounting problem that smart people in Washington will figure out eventually. But let me show you what actually happened, because this is where the simple logic does not apply. This is where we step into what I call the big secret of the entire system. The United States has accumulated over $36 trillion in debt. Let that number sit with you for a moment. $36 trillion. That's not the deficit for this year. That's the cumulative total of everything the government owes. And here's the part they never put in the official reports. Much of that debt was borrowed when interest rates were at historic lows. We're talking 0.5%, 1%, maybe 1.5% on 10-year bonds. For years, the government could borrow essentially for free. It was the ultimate teaser rate, the adjustable mortgage that starts at 2% and resets 5 years later. Well, friends, the reset is here. As those old bonds mature in 2025 and beyond, they must be paid off. The government doesn't have the cash sitting in a vault somewhere to pay them off. So what does it do? It issues new bonds, it refinances, but those new bonds can't be issued at 0.5% anymore. They have to be issued at whatever the market demands right now. And right now, that's somewhere between 4.5% and 5.5%, depending on the maturity. The debt amount didn't change. The $36 trillion is still $36 trillion, but the cost to service it tripled overnight. This is the refinancing wall, and we're hitting it at full speed. Here's where the countdown quietly began. Let's cut through the noise and talk about what this means for you, for the person working a job and paying taxes. Interest payments now consume approximately 35 to 40% of all personal income tax receipts collected by the federal government. Think about that. If you work from January through April, every single dollar of income tax you paid during those months, every dollar deducted from your paycheck, Every quarterly payment, if you're self-employed, none of it went to roads. None of it went to schools. None of it went to veterans benefits or border security or anything you might associate with government services. It went directly to bondholders. It went to creditors in China, Japan, and on Wall Street just to keep the lights on, just to service the interest on money that was borrowed years ago for programs that have already been spent. This is not theoretical, it's observable. Now, you might be thinking, okay, this sounds bad, but governments have dealt with debt before. They'll raise taxes, cut spending, grow their way out of it. And that's exactly the trap. That's the normalcy bias talking. Human beings are hardwired to believe tomorrow will look like yesterday. We assume the system that worked for decades will continue working because it always has. But here's the detail even analysts tend to miss. We're not in a normal debt situation anymore. We've crossed into what economists call Ponzi financing. Let me explain what that means, because this is the mechanism hiding in plain sight. The government is running a deficit. That means it spends more than it takes in through taxes. It doesn't have the cash flow to cover its expenses, let alone pay the interest on its existing debt. So what does it do? It borrows more money. It issues new bonds to pay the interest on the old bonds. It's not paying down principal. That's not even on the table. It's just trying to keep up with the interest payments by taking on additional debt. This creates a loop. New debt leads to higher interest payments, which increases the deficit, which requires even more new debt. This is where the first domino falls. The economist Hyman Minsky described 3 stages of debt: hedge financing, where you can pay both interest and principal from cash flow; speculative financing, where you can only pay interest and need to roll over the principal; and Ponzi financing, where you can't even pay the interest from cash flow. You have to borrow more just to stay current. The United States government has entered the Ponzi stage. This part isn't a prediction. It's math. When your interest payments exceed your defense budget, when they consume 40% of tax receipts, and when you're running trillion-dollar deficits simultaneously, you are by definition in Ponzi financing territory. And here's where everything changes. This creates what's known in the literature as fiscal dominance. It's the moment when the central bank, in this case the Federal Reserve, loses its independence. The Fed has 2 theoretical mandates: control inflation and support employment. But there's a third unspoken mandate that supersedes both when push comes to shove: keep the government solvent. The Federal Reserve can fight inflation by raising interest rates, or it can save the government by lowering them and monetizing the debt. It cannot do both. Here's the part nobody expects. The market already knows how this ends. Bond traders, the people who move billions of dollars every day based on these calculations, they've already priced in the inevitable outcome. If rates stay high, the US government goes broke under the weight of its interest payments. The debt spiral accelerates until something breaks. If rates go low, inflation returns with a vengeance because you're printing money to cover the shortfall. The Fed is trapped. Fiscal dominance means the government's financing needs dictate monetary policy, not economic conditions. The vigilantes, that's what we call the bond market, they're watching, and they're starting to demand higher yields because the risk is becoming undeniable. We don't have months. This is happening in days. Now let me show you what this looks like on the ground, because we need to zoom in from the macro to the personal. Pension funds hold enormous quantities of government bonds. They're supposed to be the safe asset, the bedrock of retirement security. But when interest rates rise and bond prices fall and they move inversely always. Those pension funds take massive losses on their existing holdings. At the same time, the states and municipalities that back those pensions are facing their own budget crunches because their tax revenues are declining as economic activity slows. The average household looking at their 401k or their pension statement doesn't see fiscal dominance or refinancing wall. They see their retirement vanishing. This is the moment small businesses get crushed. Because here's what comes next, and this is worse. When the government is hoovering up all available credit to refinance its debt, it crowds out private borrowing. Small businesses that need to expand, that need to make payroll, that need inventory loans, they get priced out of the market. The credit that would normally flow to productive enterprise gets diverted to unproductive government spending. It's not building factories or funding innovation, it's just paying interest on past consumption. The economy doesn't grow, it contracts. And in a contracting economy, tax revenues fall, which makes the deficit worse, which requires more borrowing. The spiral tightens. But that's not the real problem. The real problem is that the entire system is now dependent on one thing and one thing only: confidence. Confidence that the US government will pay its debts, confidence that the dollar will hold its value, confidence that the Federal Reserve will keep the plates spinning. The moment that confidence cracks and confidence moves faster than any other force in financial markets, the whole edifice comes apart. We're not talking about a slow decline over decades. We're talking about a rapid repricing of risk that happens over weeks or even days. This is where the cascade becomes unstoppable. Foreign holders of US debt are already moving. The BRICS nations, Brazil, Russia, India, China, South Africa, have been systematically reducing their treasury holdings. China, once the largest foreign holder, has been selling for years. They're diversifying into gold, into other currencies, into real assets. They see the same numbers we're looking at. They understand that being the largest creditor to an insolvent debtor is not a position of strength. It's a position of maximum vulnerability. When the repricing happens, they don't want to be left holding paper. And this is the crack that becomes an earthquake. Let's go back to the beginning, because to understand why this is inevitable, we need to understand how we got here. This isn't a story that started with the most recent administration or even the last decade. This is the final act of a tragedy that's been building for centuries. The architecture of sovereign debt, the very idea that governments can borrow against future tax revenues, was formalized in 1694 with the founding of the Bank of England. That was the birth of the modern bond, the innovation that allowed empires to finance wars, infrastructure, and expansion without having immediate cash on hand. For 300 years, this system worked because empires could expand, could conquer new territories, could extract resources, could grow their economies faster than their debts grew. But once this shifts, everything above it starts to shake. The United States inherited this system and perfected it in the 20th century. After World War II, America became the global reserve currency. The dollar wasn't just money, it was the money. Every commodity, every international transaction, every central bank's reserves were denominated in dollars. This gave the US an extraordinary privilege. It could print money, run deficits, and export the inflation to the rest of the world. As long as everyone needed dollars for trade, America could borrow without the normal constraints. It was the ultimate asymmetric advantage. This leads us to the system's most crucial secret, which we will explore now. The secret is this: sovereign debt was never designed to be paid back. Let me say that again. because it defies everything you've been taught about personal finance, about responsibility, about living within your means. Government debt at the scale we're talking about was never meant to be paid off. It was meant to be rolled over indefinitely, refinanced in perpetuity, as long as the economy grew faster than the debt grew, as long as tax revenues increased, as long as confidence held, the debt could expand without consequence. It's a 200-page IOU written to itself, backed not by gold or assets, but by the promise of future taxation and economic growth. It sounds insane, but the data is unambiguous. And for decades, it worked. The US economy grew at 3%, 4%, sometimes 5% annually. Tax revenues increased. The debt to GDP ratio stayed manageable. Even when deficits spiked during wars or recessions, the underlying assumption was that growth would eventually outpace the borrowing. The bond market believed it. Foreign governments believed it. The entire financial system was built on that belief. But here's where common sense actually becomes your enemy. Because what happens when growth stops? What happens when an economy matures, when the population ages, when productivity gains slow, when you've already extracted most of the easy growth from industrialization and technology? What happens when the debt grows faster than the economy that's supposed to service it? You hit the mathematical endgame. You reach the point where the interest payments alone consume so much of the budget that you can't fund anything else without borrowing more. And once you're in that position, once you're in the Ponzi phase, there are only three ways out. Let me be precise about what those three options are. Option one, you default outright. You tell your creditors, we're not paying. This is catastrophic. It destroys your currency, your ability to borrow in the future, your position in the global order. No superpower has ever chosen this option willingly. It's reserved for failed states and collapsed empires after everything else has been tried. Option two, you implement brutal austerity, you slash spending, raise taxes, transfer wealth from the population to the creditors, you pay your debts by impoverishing your own citizens. This is what happened to Greece, to Argentina, to numerous countries that borrowed more than they could repay. The social cost is enormous. Revolutions have started over less. Option three, you inflate your way out. You print money, you monetize the debt, you devalue your currency so that the nominal debt remains the same, but its real value, its purchasing power, collapses. You make your creditors whole in dollars that are worth a fraction of what they were worth when the debt was incurred. This is the path of least resistance for a reserve currency issuer. It's politically feasible because the pain is hidden in the grocery store, in the gas station, in the slow erosion of savings rather than an immediate visible collapse. The data forces one conclusion. The United States is choosing option three. And this is where the breaking point actually accelerates. Because once the market understands that inflation is the chosen path, once creditors realize they're going to be paid back in devalued currency, they demand higher yields to compensate for that risk. Those higher yields increase the interest payments, which increases the deficit, which requires more money printing, which increases inflation, which demands even higher yields. It's a feedback loop. It's the debt spiral going vertical. This is not a conspiracy. It is a stated policy. The Federal Reserve has already demonstrated its willingness to intervene in the bond market. During the pandemic, it purchased trillions of dollars in government debt directly. It expanded its balance sheet from under $4 trillion to over $9 trillion in a matter of months. That was quantitative easing on a scale never before attempted, and it worked in the sense that it prevented an immediate collapse, but it also set a precedent. It showed the market that when push comes to shove, the Fed will monetize the debt. It will print money to buy government bonds if no one else will. Here's the moment the clock actually starts. Because now in 2025, we're facing a situation where the government needs to refinance not millions or billions, but trillions of dollars of maturing debt at interest rates that are 3 to 5 times higher than when that debt was originally issued. The Congressional Budget Office's own projections show interest payments potentially hitting $1.4 trillion, $1.6 trillion, $2 trillion annually in the coming years if rates stay elevated. At that point, interest becomes the single largest line item in the federal budget, surpassing even Social Security. For pensions, this is catastrophic. Let me show you how this connects to something you can see right now, something tangible that proves the rot is real. Bitcoin. Everyone watches Bitcoin because it's volatile, it's headline grabbing, it moves 10% in a day. But Bitcoin isn't just a speculative asset anymore. It's become a liquidity canary. When the government is absorbing enormous amounts of credit to refinance its debt, when the Fed is tightening or even just not loosening, liquidity drains from the system, and Bitcoin, like all risk assets, is extraordinarily sensitive to liquidity conditions. When Bitcoin crashes despite no change in its fundamentals, despite growing adoption, despite institutional acceptance, that's not a Bitcoin problem. That's a liquidity problem. It's telling you that the financial plumbing is under stress. This is the detail even analysts tend to miss. The same thing is happening in the stock market, but it's more subtle because stock prices can be supported by buybacks, by corporate cash flows, by earnings manipulation. But look under the hood. Look at what happened to some of the smaller players, the companies that depend on cheap credit to operate. I'm talking about firms like Tricolor, a subprime auto lender that collapsed when its credit lines froze. I'm talking about companies like First Brands Group, which filed for bankruptcy when it couldn't refinance its debt. These aren't household names, but they're forensic evidence. They're the first casualties of a credit contraction. When you hear about these failures, it's not because those specific companies made catastrophic management errors. It's because the tide of liquidity is going out. And as Warren Buffett famously said, that's when you find out who's swimming naked. The liquidity tide is going out, and we are about to find out who is swimming naked. Now, here's where it gets even more uncomfortable, because we need to talk about the psychology of all this. We need to talk about why most people, even very smart people, even people who understand these numbers intellectually, will not act on this information until it's too late. It's called normalcy bias. It's the human tendency to believe that tomorrow will look like yesterday, that the systems we've relied on our entire lives will continue functioning because they always have. You see the data, you understand the math, but you think, surely someone will fix this. Surely the politicians will come to their senses. Surely the Fed has tools we don't know about. This is where the system quietly depends on your inaction, because the system requires mass participation. It requires millions of people to keep their savings in dollars, to keep buying bonds, to keep believing that paper assets will hold their value. The moment everyone simultaneously tries to exit, the moment the herd stampedes, there's no exit wide enough, the market seizes up. This is why governments and central banks work so hard to maintain confidence, to massage the data, to reassure the public, not because they're lying necessarily, but because they understand that panic is self-fulfilling. If everyone believes the currency is doomed, the currency is doomed. But we haven't even reached the breaking point yet. Let's talk about what happens in the real economy, because this isn't just about numbers on a screen or yields on a bond. This is about how people live. When the government is consuming 40% of tax receipts just on interest, something else has to give. Social programs get cut, infrastructure crumbles. The military, despite its enormous budget, starts losing readiness because maintenance is deferred. The VA runs out of funding. Medicare gets squeezed. These aren't theoretical future problems. These are the trade offs happening right now in budget negotiations. Every dollar that goes to interest is a dollar that doesn't go to something else. Here's what that looks like on the ground. For the average household, this manifests as a slow, grinding decline in living standards. Your paycheck might not change in nominal terms, but everything costs more. Housing, healthcare, education, food, all the necessities that eat up the majority of a family's budget, they're all inflating faster than wages. You become a millionaire on paper because your home value doubled, but you're poorer at the grocery store because milk costs $8 a gallon. This is the money illusion. The numbers go up, but the purchasing power goes down. This part was inevitable the moment the debt crossed $20 trillion, then $25 trillion, then $30 trillion. And here's where the no escape encirclement happens, because let's systematically go through the traditional safe havens and see why each one fails in this environment. Stocks require liquidity and economic growth. When liquidity is being drained to finance government debt and growth is stalling under the weight of that debt, stocks become incredibly vulnerable. Yes, they can have bear market rallies. Yes, they can be temporarily supported, but the underlying dynamic is hostile. Bonds are the eye of the storm. If you own a government bond yielding 4%, and inflation is running at 6% or 8% or 10%, you're losing purchasing power every single day you hold it. The longer you hold it, the more you lose. Cash is being deliberately debased. That's the whole point of inflation, to make the debt manageable by making the currency worth less, because what comes next is worse. Real estate seems like it should be a hedge, and in some ways it is, but real estate has its own problems in this environment. Property taxes rise with inflation, maintenance costs skyrocket. If you're leveraged, your mortgage payment might be fixed, but if rates have risen and you need to sell, the pool of qualified buyers shrinks dramatically. Real estate is also highly illiquid. You can't sell half your house if you need cash, and this is where everything changes. So we arrive at the convergence, the point where multiple structural failures hit simultaneously and create a crisis that can no longer be managed with the usual tools. Let me lay out the three forces that are colliding right now, today, at the end of 2025. Force number one, the unstoppable compounding of interest payments. This isn't linear growth. This is exponential. When your interest payment is nearly $1 trillion and you're running a deficit, that trillion gets added to the principal. Next year, you're paying interest on an even larger debt stock. The year after that, larger still. It's compound interest working against you at the scale of a nation. And because of the refinancing wall we discussed, because trillions of dollars of low-rate debt are maturing and being replaced with high-rate debt, the interest expense is accelerating faster than even the pessimistic projections anticipated. This was inevitable the moment Japan's experiment with zero rates ended. Let me explain that connection, because it's crucial and it's one of the hidden mechanisms that most people don't understand. For over 2 decades, Japan maintained interest rates at essentially zero. This created what's called the carry trade. Sophisticated investors and institutions would borrow money in yen at 0% interest, convert it to dollars or other currencies, and invest it in higher yielding assets around the world. This was free money. It flooded the global financial system with liquidity. It kept asset prices inflated. It allowed the US Treasury to find ready buyers for its debt, because that debt, even at relatively low yields, was attractive compared to the zero you'd get in Japan. Here's the part they never put in the official reports. When Japan finally started raising rates in 2024 and into 2025, even tiny rate hikes of 0.25%, the carry trade began to unwind. Suddenly, borrowing in yen wasn't free anymore. The trade that had pumped trillions of dollars of liquidity into global markets for 20 years reversed. Capital flowed back to Japan. This is deflationary for the rest of the world. It's a massive liquidity withdrawal. And the US Treasury, which had grown accustomed to easy foreign demand for its bonds, suddenly faced a much less accommodating market. This is where the crack becomes an earthquake. Force number 2, foreign divestment. The BRICS nations aren't just reducing their treasury holdings as a matter of portfolio management. They're actively building an alternative system. They're settling trade in their own currencies. They're accumulating gold at a pace not seen since the 1970s. China added over 200 tons of gold to its reserves in a single year. Russia's central bank has been a relentless buyer. India, Saudi Arabia, Turkey, all of them are diversifying away from dollars and into tangible assets. This isn't a conspiracy theory. This is stated policy. They've announced these initiatives publicly. They're creating alternative payment rails, alternative reserve assets, because they've done the same math we're doing. They see a debtor nation that's spending more on interest than defense, and they're positioning themselves for the repricing. Let me show you what actually happened at the most recent BRICS summit. The expansion of BRICS to include Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran wasn't just symbolic. It represented a direct challenge to the petrodollar system. For 50 years, oil has been priced and traded primarily in US dollars. This created automatic demand for dollars from every country that imports energy. It was a structural support for the dollar's reserve status. But when the Saudis start accepting yuan for oil sales to China, when they start discussing gold-backed settlement mechanisms, that structural support begins to crack. Each crack is small. Each individual transaction is manageable. But the cumulative effect is a slow-motion depeg of commodities from the dollar. And once this shifts, everything above it starts to shake. Force number 3. The inevitability of yield curve control or outright monetization. The Federal Reserve is trapped in an impossible position. If it keeps rates high to fight inflation, it bankrupts the government through interest payments. If it cuts rates prematurely, inflation resurges and the dollar loses credibility. The only remaining option, the option that every over-indebted developed nation eventually chooses, is yield curve control. This is when the central bank announces it will buy unlimited quantities of government bonds to keep yields at a specific level. It's an explicit cap on interest rates regardless of what the market would naturally price them at. This is not theoretical. It's observable in Japan, in Europe, in every advanced economy that's hit this wall. Japan implemented yield curve control years ago. The Bank of Japan literally capped 10-year government bond yields at 0.25%, then 0.5%, buying whatever quantity of bonds was necessary to maintain that cap. It worked in the sense that the Japanese government didn't default. But it also meant the yen depreciated by 30% against the dollar at one point. It meant inflation returned to Japan after decades of deflation. It meant financial repression. Savers were punished, purchasing power eroded, and the central bank's balance sheet ballooned to over 100% of GDP. The United States is heading for the same outcome, just from a different starting point. When, not if, But when the Fed implements yield curve control or returns to massive quantitative easing to finance the government, it will be framed as a necessary measure to ensure financial stability, to prevent a disorderly market, to protect the economy. And technically, those justifications won't be wrong. The alternative, allowing the US government to default or allowing interest rates to rise to double digits, would be catastrophic. But the consequence of that intervention is the same: currency debasement. The dollar will be printed in sufficient quantities to keep the system functioning, and that printing will destroy the dollar's purchasing power. This part isn't a prediction, it's math. Now, let's talk about the repricing, because this is where we shift from diagnosis to forecast. Gold isn't rising to 4,000 or 5,000 or higher because gold is becoming more valuable. Gold is the constant. An ounce of gold today contains the same atoms as an ounce of gold a century ago. What's changing is the value of the currency it's priced in. When the dollar supply expands to cover interest payments, to monetize deficits, to keep the system liquid, the dollar loses value relative to finite assets. This is the repricing. Here's the part that scares me most. Most people think of inflation as prices going up, but that's the symptom, not the cause. The cause is too much money chasing too few goods. And in this case, it's not even organic economic money, it's conjured money, digital entries on a Federal Reserve balance sheet created to buy government bonds. That money eventually enters the real economy. It gets paid out as government salaries, as Social Security checks, as defense contractor payments. And when it does, it competes with existing dollars for the same goods and services. Prices adjust. The currency reprices. Gold at $4,000 isn't the gold bull market, it's the dollar bear market. Let's zoom in one more time to what this means for an individual, because the macro is important, but the personal is where decisions get made. You've worked for 30 years, you've saved diligently, you have $500,000 in a retirement account, mostly in index funds and bonds. You think you're prepared. But if the dollar loses 50% of its purchasing power over the next 5 years, and that's not an extreme scenario given the dynamics we've discussed, your $500,000 can buy what $250,000 can buy today. You're not broke. You still have $500,000 in nominal terms, but you're functionally half as wealthy. The money illusion makes you think you still have your nest egg. The grocery store, the doctor's office, the insurance bill, they tell you different. This is the moment pensions get crushed, because pensions made promises in nominal dollars. They promised to pay you $3,000 a month in retirement, and they will. The checks will clear. But that $3,000 a month, which seemed comfortable when the promise was made, now barely covers rent. The pension fund managers aren't lying to you. They're delivering exactly what they promised. It's just that what they promised has been devalued by forces completely outside their control. Now let's cut through the noise and talk about what you can actually do. The binary choice is this: do you want to own assets, or do you want to own claims on assets? This distinction is everything. A stock certificate is a claim on a company's future earnings. A bond is a claim on future government tax revenues. A dollar bill is a claim on future goods and services, backed by nothing but the government's promise and the market's confidence. These are all paper. They're all abstractions. They exist within the system, and they're only as good as the system's stability. Real assets are different. Gold is not a claim, it's the asset itself. Silver is not a promise, it's the metal in your hand. Land is not an abstraction, it's physical space that exists regardless of what happens to currency or governments. These are outside money. They have no counterparty risk. They don't depend on someone else's solvency or promise to maintain their value. Let me be precise about why gold specifically Gold has been money for 5,000 years. It's been the ultimate store of value across every civilization, every empire, every monetary system. When Rome debased its currency, gold preserved wealth. When Weimar Germany hyperinflated, gold preserved wealth. When the US left the gold standard in 1971 and the dollar lost 98% of its purchasing power over the subsequent 50 years, gold preserved wealth. It's not a perfect inflation hedge year to year. Nothing is. But over long periods, especially during periods of monetary chaos, gold reprices to reflect the expansion of the money supply. Here's where everything changes for those who understand this. Central banks know this. That's why they hold gold. That's why China is accumulating it. That's why Russia is accumulating it. They're not buying gold because they think it's a good trade. They're buying gold because they're preparing for a world where dollar dominance is reduced, where the monetary system is in flux, where hard assets matter more than paper claims. If you want to know what the smart money is doing, and by smart money, I mean the sovereign wealth funds, the central banks, the billionaires who have access to the best information, look at their gold purchases. They're voting with their capital. This is a default in all but name. When a government can only service its interest payments by borrowing more money, when it's running trillion-dollar deficits with no plan to balance the budget, when its debt to GDP ratio is rising exponentially, that government is in default. It might not call it that. It will continue to make payments in nominal terms. But in real terms, in purchasing power terms, it's defaulting on its obligations. It's paying creditors back in currency that's worth a fraction of what it was worth when they lent the money. You have a choice to make, and the window for making it is narrowing. You can stay inside the system, holding paper assets denominated in a currency that's being systematically devalued to manage an impossible debt burden, or you can step outside the system, converting paper claims into tangible assets that have intrinsic value independent of any government's fiscal policy. This isn't about getting rich. This isn't about speculation. This is about not getting poor. It's about preserving what you've already built against a monetary tsunami that's already in motion. The empire's crossover, interest exceeding defense, is not a milestone. It's a tombstone. It marks the point where the mathematics became unsustainable, where the system entered terminal phase. History favors the prepared. The Romans didn't wake up one day and discover their empire had fallen. It decayed over decades, visible to anyone paying attention, but denied by most until it was too late. The British Empire didn't collapse overnight. It declined slowly, then suddenly, and those who saw it coming and positioned accordingly preserved their wealth across the transition. We are in that transition right now. I'm not telling you this to frighten you, friends. I'm telling you this because you deserve to know. You deserve to understand the structural reality of what's happening to the monetary system, to the debt, to the dollar. You deserve the information that allows you to make informed decisions for yourself and your family. The mainstream financial press won't tell you this story. They're incentivized to keep you optimistic, keep you invested, keep you believing the system is fundamentally sound. The politicians won't tell you this story because they're the ones who created the problem through decades of fiscal irresponsibility. But the numbers tell the story. The Treasury's own data tells the story. The crossover tells the story. The moment when interest exceeded defense was the moment the empire's priorities were revealed. Pay the creditors or defend the borders. Service the past or secure the future. The system chose the past. It chose the debt. And that choice has consequences that are mathematical, inevitable, and already unfolding. Friends, we don't have the luxury of time. The refinancing wall is here. The carry trade has unwound. Foreign creditors are diversifying. The debt spiral is accelerating. The Fed will eventually be forced to choose between a government default and currency debasement, and we all know which option they'll choose. The question is not whether the repricing happens. The question is whether you're positioned for it when it does. History doesn't repeat, but it rhymes. Every empire that spent more on its debts than its defense eventually fell. Every currency that was printed to cover impossible obligations eventually collapsed. This is not American exceptionalism failing. This is mathematical certainty asserting itself. The architecture has a fault line, and the weight on top of it is too great. The prepared survive the transition. The unprepared suffer through it. Thank you for being here today. Thank you for caring enough to understand what's really happening beneath the headlines and the talking points. The information I've shared with you today isn't hidden. It's public data, it's Treasury reports, it's central bank balance sheets, but it's presented in a way that most people never see, never connect, never act on. You now have that information. What you do with it is up to you. But I'll leave you with this. In times of monetary chaos, the ancient truth reasserts itself. Real assets outlast paper promises. Gold outlasts empires. And those who understand the difference between owning an asset and owning a claim on an asset, they're the ones who preserve wealth across the great transitions. The window is closing. The crossover has happened. The mathematics are implacable, and history is watching.